What's up, guys? Jordan from Condo here. Today we are going to do another market update. So it's been, I believe, a month since my last one. Market conditions have changed a little bit. Just going to update you on what's going on. So first thing I want to talk about is just the condo price. So there's a lot of articles out there. I see tons of realtors putting out reports about average price being up, some saying average price is down. Depends on who you listen to. So I just want to kind of give you a snapshot of where we're at today with pricing. So prices are relatively flat versus this time last year. They're up marginally. So the red line here is the average price. The blue line is the median price. And as you can see, they're pretty well correlated. The separation between median and average that we see, this year versus this time last year is because we're seeing a higher distribution, a higher price distribution. So we're seeing, less condos in the lower price category move, but we're seeing a very active market north of $1 million. So because of that reason, you're seeing the average and median price sort of separate a little bit. In terms of where we're at today, price-wise versus, this time last year for a similar condo, for the most part, we're up 2 or 3%. But if you're comparing to the market highs in February of this year, prices are down 5% or so. And this does a really good job of illustrating the price difference in terms of detached versus condos. So the condo market has been trading relatively sideways this year in terms of pricing, but the detached market is absolutely on fire. So because of that, we're seeing a widening in the gap between the median price of a condo and the median price of a detached home. So it's becoming considerably more expensive to get yourself into a detached than the 2x multiple that we normally look for in a healthy market. And what that means is this is giving a runway, this is giving an opportunity for sometime in the future condos to make up that difference, or for a correction in the detached pricing. Of course, we're seeing consumer trends, consumer behavior change a little bit because of COVID, so people are looking for more space. But inevitably, when condos are that much of a better deal than detached, you're either going to see condos run up in price to meet that multiple, or you're going to see detached correct a little bit, like we did see in 2016-17 here. All right, so if you are an investor, or even if you're a homeowner, you might be a little scared by the fact that prices are down over February, so this year's highs, but it shouldn't. All things considered, we're doing incredibly well here in Toronto. The only people who are sitting anywhere near negative equity are people who really bought in January, February, or March of this year. Anyone who bought prior to that is positive equity, or at least break even, neutral, which is, all things considered, when you look at other major metros, when you look at San Francisco and Chicago and New York, we're doing very, very well. We only have 4 months of inventory. So 4 months of inventory is a balanced market. If you remember, anything below 3 is a seller's market, anything above 5 is a buyer's market, anything above 6 really is a buyer's market where prices start to decline. We're sitting about 4 months of inventory. Manhattan has over 10 months of inventory. Miami has even more than that. So again, all things considered, we're doing very, very well. Where this extra inventory is coming from, predominantly because investors are cashing out, right? So most of this inventory is concentrated in the smaller condo segment. As I said earlier, the larger stuff is still moving very well. Stuff above $1 million is $1 million condos and above are actually selling better now than they were just 12 months ago. So it's a concentration of supply in the entry level market. So if you're someone who's looking at buying your first home, now is actually a really good time to start looking, because you're getting a discount of 5 to 10% over what you would have paid in February because of all of this supply from Airbnb investors who can't find long-term tenants to help them service their debt, and so they're cashing out. And that's where predominantly this increase in supply is coming from. One thing I would say is, this is actually maybe just what the market needed, funny enough. If you look back to the first quarter of 2020, the market was getting very frothy. You can see here, year over year, price per square foot appreciation in Toronto of 15%, very reminiscent of 2016 through 17, where we saw 30% appreciation. And some of the guys on my team who focus predominantly on resale we're getting incredibly frustrated in January and February because any decent condo under $650,000, $700,000 was selling with multiple offers, and it was getting incredibly frustrating out there for buyers, and we were seeing very rapid price appreciation. So this cool down might just be what the market needed, and take it for what it's worth. But in the last week or last week to 2 weeks, I've been hearing a lot from agents on my team and agents who are colleagues and friends of mine who do a lot of volume in the resale side of things, that market, that sub 700K market, is starting to really heat up again. Inventory is starting to slow down, and buyers are starting to come out, and we're starting to see some multiples return. So where is this inventory coming from? Again, predominantly it's coming from short-term rentals, Airbnb rentals, and rentals that were for international students. And we don't have international students this year. So you have two things kind of hitting the market at the same time. You have no international students flooding in to lease these small units near U of T, near Ryerson, and then you have no Airbnb tourism, so you have all of those Airbnb landlords listing their units on the long-term rental market, really saturating this market when there's not a whole lot of tenants looking to lease something downtown. And so what we've seen is that the rental price for condos is down about 12% in the downtown core, but only between 2 and 5% for the suburbs. And they're turning to the resale market to get rid of those units, and so we're seeing price decline a little bit, not nearly anywhere what rent is seeing, but we're starting to see some downward pressure on prices. Like I said, there's been more activity in the last 2 weeks, so we'll see if that trend kind of holds up. And if it does, then this is the bottom, which, again, prices are up over this time last year. This is a great graph from Globe and Mail, shows that the job losses during COVID were predominantly in the lower wage sector, so $22 an hour and below, so entry level service sector type jobs. Again, not people who can necessarily afford to purchase a condo without significant help. So these are less likely to be people in the resale market, more likely to be people in the rental market. It is no secret that interest rates are incredibly low. To give you perspective, Riley on our team just bought a beautiful loft, a one bedroom for well over $800,000, I think it was, and he got a variable mortgage at 1.35%. Clients of mine who just bought a $1 million condo in the East End got, I think, 1.89%, 5-year fixed. We know that the Federal Reserve in America's goal is to inflation average at 2% a year. So essentially they're going to basically, if you're reading between the lines, they're going to print as much stimulus as necessary in order to hit 2% inflation per year, right? And we know we're going to do similar things in Canada. And so what that means is if you're getting your mortgage at 1.9%, but inflation is 2%, then the mortgage is literally free money. And so that's obviously a growth factor as far as real estate goes. It makes it far easier to invest in real estate if you have the income to support the debt. But an even bigger story than if you understand where Canada and America and basically all the G7 countries are in terms of debt, it's pretty easy to see that rates aren't going anywhere anytime soon. The whole system would implode on itself. Now, putting that aside, I think the bigger story than that is the immigration targets. So if you look at the immigration targets over the last 4 years, we're obviously up massively. So in 2019, Toronto saw an increase in population via immigration of 127,000 people. And in 2018, that number was 125,000 people. And they want to keep increasing the amount of immigration. We know that Toronto and the GTA as a whole gets the lion's share of the immigration. And while that's being said, we can't deliver nearly enough homes to actually support the population growth. And this is the crux of our issue here in Toronto. This is why we appreciate at 8% a year when a healthy market is more like 3 to 5%. It's going to be a very bad decade to not own real estate and to not own hard assets, especially when you can see, despite higher unemployment than usual, our plan for recovery is very clearly immigrate. And we know most of those people are going to flood into the GTA. Yes, most of them are going to have jobs because we focus on skilled immigration here in Canada. And that means many of them can afford to buy, and they're an inflating factor on our housing costs. So this is fantastic if you own real estate, super depressing if you don't own real estate, and if you don't have a job, this is probably upsetting to hear because this is going to flood our labor market. But with that being said, again, bad decade to not own hard assets. Now let's talk about new condo launches. 2019 was a relatively slow year for condo launches. You can actually see that condo launches in Toronto are declining 2011 through 2019. While the population growth is increasing year over year, the actual new condo launches are decreasing. Why is that? Well, the primary reason for that decline is we are running out of land, right? It's becoming more and more expensive to develop in Toronto. Land cost is going up, construction cost is going up. Heritage buildings don't make it any easier. There's a number of reasons that I'm not going to go into this video, but if you look at the launches this year, we had far fewer than we were supposed to because of COVID. A lot of builders were playing wait and see because they can afford to. But what that means is we're going to have a couple of years, 4 or 5 years out from now, that are going to be very low home completion years. So COVID has effectively it's cut immigration for a year, but our plan is to ramp up immigration to make up for that shortfall. There is no real way to ramp up housing completion to make up for that increase in immigration, right? So we're going to have a few years in the future where we're going to be incredibly supply starved. There's going to be very little home completion in those years, and that's obviously going to drive up pricing. So again, the long-term narrative for Toronto housing has not changed. These new immigration targets are astronomical. They are absolutely going to be an inflating factor in the housing market. And our prices are still up year over year. There's still opportunity for price regression before the end of the year. I'm not saying with any degree of certainty that the worst is over. It may get worse before it gets better, but if you're someone who's a first-time home buyer or a first-time investor and you're looking for an opportunity, now's a really good time to at least start looking. If you like this video, give me a like. If you don't like it, give me a dislike. Subscribe if you want more information on the Toronto housing market. And if you have any questions, as always, reach out to me, Jordan@precondo.ca. Take care, guys.